Okay, welcome to this lesson on moving average. Again, this is part 2. Okay, so some of the ways to use moving averages. The first one is a crossover. Second way you can use it is use it as a dynamic support and resistance. Third way is used to determine the direction and strength of trend. Now the thing about moving averages is that when it comes to something like a crossover, you cannot just rely on crossovers to enter because it is lagging the price, and also sometimes there may be false crossovers. So with all these 3 methods, you gotta make sure that you use confirmation. For example, price action candlesticks. Now how not to use moving averages? First one is, like I said, don't use it to enter without confirmation, and don't use it in a ranging or volatile market. When it comes to a volatile asset, for example, if you apply moving averages to something like Bitcoin, okay, it's not going to work out so well. And some more, when it is trading in a ranging market just like this, you see so many false crossovers where the price broke above and then below and then above. Then this one, it tests one time, then it broke above again, then broke below. So you can see that moving averages kind of lose its function during a ranging market. Alright, so you want to use it in a trending market. Okay, and also if the markets are moving really fast, really volatile, then you also want to ignore your moving averages. Okay, some rules to take notes. Like I said, it is suitable to be used in trending markets. It cannot be used in isolation, and it signals a potential reversion to mean. Remember when I said when the price goes way too far beyond the long-term moving averages, it's going to snap back. Okay, you gotta use the right settings according to the time frame you trade. Like I said, if you're a really short-term trader, then you use shorter-term moving averages. If you're a medium-term trader, then you use the medium-term. If you're a long-term trader, then you use the longer-term. But with that said, don't get too caught up with, okay, what's the perfect moving average number, because you're holding the trade not for seconds, not for minutes. You're holding it for hours and sometimes days, and sometimes weeks and months if you trade the higher time frames. So it doesn't really matter. As long as you use the moving averages that give you the right signal at the right time, then it's fine. And it's suitable to be used in less volatile markets. Okay. And one principle about moving average that you need to take note of is that the more times the price comes out and tests, okay, the more times it acts as a resistance, the stronger will be the price movement when it does break above the moving average. It's just like a support resistance. The more test points there are, then the stronger the support resistance. It's just the same thing. And also once in a while you find that price would go below the moving average, but then moving average is still sloping up. It's giving you contradicting signals. So if you see this kind of thing happening, you want to avoid buying. Okay, even though there's an uptrend, moving average is sloping up, you want to avoid buying. Okay, but of course you need a lot more indicators for you to tell whether this is the end of the trend, or is this just a false crossover? Okay, just a bit of recap from the previous lesson. These are 50 SMA, which is the yellow line. As a buyer, since this is a buy trend, since this is a bullish trend, we are looking for a buy trade. As a buyer, it is better to buy at a cheap price. Okay, it's just like when you go shopping, you want to buy when it is on a discount. So you want to wait for the price to come down on a retracement, and then you buy when there's a support. Come down on a retracement, you buy on this support when it tests 50 SMA. You don't want to buy on a high point like this point, and this point, okay? You want to buy when the price retrace and tests 50 SMA, like over here. You will buy again when it retrace and tests a support level. Okay, let me give you some examples. Now one thing you need to take note of is that the larger the gap between the moving averages, and hence the stronger would be the bearish trend. Okay, now the thing is, how do you enter? into a trade using moving averages. Of course, normally we would add an additional confirmation indicator, which would be somewhere below the chart here, but let's just keep this simple right now without using our confirmation indicators. Okay, so let's just look at price action. So for example, you can see over here, this is a bearish candlestick pattern. If you haven't went through the candlestick lessons, then make sure you go through it. Okay, so what you can do is that after you see this bearish candlestick pattern, you can enter over here. Alright, and the thing is, it is testing this 100 SMA, so you can put your stop slightly above 100 SMA. Then you can put your TP at the recent swing low. Okay, just like that. And most importantly, make sure you are trading in a bearish trend. Your 50 is below 100, 100 is below 200, and it is all sloping down. And when it comes to spotting crossovers, you can see that when the price extends way too far off from the 100 SMA, okay, it has to come back to the mean. It is sort of like a magnet. You see, when the price goes too far, that's why you don't want to buy at the high points, because you know that price will eventually have to come back to the mean and test your 100 SMA. Now you can see that this is your 50, okay? It crossed below 100 SMA right here. So is this a sell trade? It's not, because if you look closely, your 100 SMA is still sloping up. So even though 50 is sloping down, it crossed below, but then 100 is still sloping up. And moreover, price is still above 200 SMA, so it is not a sell trade. Until right here, okay? 50 SMA crossed below 100 SMA, and price at the same time crossed below 200 SMA. Yes, price crossed below 200 SMA over here, but then 50 hasn't crossed below 100. And normally you'll find that 50 will cross below 100 before 200 gives you the signal. Because the faster SMA, normally it will give you faster signals. Okay? The 50 and 100. But then sometimes, once in a while, you'll find that 200 will give you the signal first. But it seldom occurs. Of course, you can add these with confirmations like divergence and then candlestick signal for you to confirm that the trend has completely ended. Okay. And the thing about the slope of the moving average is that you gotta take note of that as well, because if the slope is too steep, and when there's a breakout below the moving average, the breakout wouldn't be that strong. It is like a trend line. If a trend line is too steep, if it breaks below a very steep trend line, the breakout wouldn't last that long. So of course you want the moving average to be sloping up, but not sloping up by too much, okay? And the thing is, the steeper the moving averages, the higher chance that the crossover would be a false signal. And by steep, I mean that if it is more than 45 degrees, to be safe 60 degrees, okay? Even visually you can tell. Even by visually you can tell, okay, this trend is going up too fast, right? And hence the moving averages, you see that it is going up in a very steep manner. And hence when it does break below moving average, you gotta be careful of a false signal. 50 crossed below 100 and then it went up all the way here again before it continued on the downtrend. Like I said, you cannot just rely on moving average to tell you whether the trend has ended or not. You need a lot more confirmations. I'll teach you that in the next few lessons. Okay, so with that, I'll talk to you in the next lesson. Bye.